Apple goes into earnings this week almost at its all-time high. The business looks stronger than ever. Revenue grew 17%, and margins hit a record. But in that same report, Apple gave a warning. The chips and memory inside its products are about to get more expensive. So the real question this week is not, can Apple beat? It is whether record profits can survive the costs coming next. To see why, split Apple into two engines. The first is products. The iPhones, the Macs, the hardware. That is still most of the money. The second is services. The App Store, iCloud, subscriptions. And here's the part that matters. Services is barely a quarter of Apple's sales, but it earns almost half of Apple's profit. Every dollar of services is almost 8 times as profitable as a dollar of hardware. That is the engine holding Apple's margins up. But the rising costs hit the hardware side first, which is how Apple can post a great quarter and still say something that moves the stock. Now, the bull case. And it is a strong one, so let's give it a fair hearing. iPhone sales jumped almost 22%. China grew after years of worry. Services set another record. And more than 2.5 billion Apple devices are now in active use around the world. This is not a weak company propped up by a story. The demand is real. But the stock has already run past Wall Street's average target of about $327. At today's price, investors are already paying for a win, not just hoping for one. So here's the number that decides everything. Apple today trades at about 41 times its yearly earnings. In plain terms, for every dollar Apple earns in a year, investors pay 41. Apple's normal over the last 5 years is closer to 28. At that normal multiple, a fair price lands in the low 200s. Today, the stock is well above 300. Now the reveal that surprised me. I split that gap into two pieces. How much comes from Apple's record margins, and how much comes from the high multiple investors are paying. The record margins explain only a small slice of the price. Almost the entire gap is the multiple. It is what people are willing to pay, not what Apple is earning. And that is the fragile part. Margins are anchored to the business. The multiple is just confidence, and confidence can reset in one earnings call. Which means Apple can beat this week and the stock can still fall if the outlook makes that high multiple harder to justify. So when the report lands, most of the numbers are noise. A few actually matter. The first is the profit margin. Near its record of 49%, the story holds. Slipping toward 46, that is the first crack. The second is services. As long as that high profit engine keeps growing, the whole machine keeps working. The third is the hardware margin. That is where the rising chip and memory costs show up first. And earnings, of course. But a small beat on earnings alone is not enough to justify this price. Here is the one line to actually wait for. Not this quarter's numbers. Apple's guidance for next quarter's margins. That single sentence about what comes next is the thing most likely to move the stock. So here's where I land. If Apple beats and margin guidance holds, the careful move is still to wait and not chase it up here. If Apple misses on margins, this stretched price gets much harder to defend, and there is real room below. And if it is mixed, don't force it. Wait for the full picture before deciding. Now, one way I could be wrong. If Apple can hold these record margins straight through a rising cost cycle, then this is not a stretched price. It is the new normal, and history is the wrong guide. That is the real test this week. Apple is an exceptional business. The only question is whether it deserves an exceptional price right before its toughest margin test in years. So, with all that said, thank you so much for watching. And please don't forget to like and subscribe to the channel.